Imagine waking up every morning knowing that your family's financial future is secure. No more worrying about how you'll pay the bills, where the next paycheck is coming from, or whether there's enough money in the bank to handle an unexpected emergency. What if I told you that with the right financial planning, this is possible? You can set your family up for success, no matter what life throws your way. Now, I know that this might sound like a distant dream, but today I'm going to show you how to make this a reality. But before we dive into the details, if you find this information valuable, I encourage you to hit that subscribe button and join our growing community. We're working towards 1,000 subscribers, and your support can help us make that happen. Let's get started. Understanding family budgeting. Why budgeting is the foundation of financial freedom. Budgeting is the key to understanding and controlling your money. If you can master your family budget, you're already on the path to financial success. But budgeting doesn't mean cutting out fun or feeling restricted. Quite the opposite. Budgeting helps you allocate your resources efficiently so you can spend on what truly matters to your family, save for the future, and avoid overspending. Different approaches to family budgeting. Zero-based budgeting. Start from zero and allocate every dollar of your income to specific expenses, savings, or debt repayment. This method ensures that every dollar has a purpose. 50-30-20 rule, a simplified approach where you allocate 50% of your income to necessities, housing, utilities, 30% to discretionary spending, entertainment, dining, and 20% to savings and debt. Envelope system, a more traditional method where you put cash in envelopes for each category, e.g., groceries, entertainment. Once the envelope is empty, you stop spending. Engagement opportunity. How many of you currently track your family's expenses? What methods or tools have you found to be most effective for budgeting? Tools for effective budgeting. Apps like Mint, YNAB, EveryDollar. These tools sync directly to your bank accounts, categorizing your expenses and giving you real-time insights. Spreadsheets. For those who prefer a more hands-on approach, a spreadsheet can help you track every cent you earn and spend. Cash flow management. Managing cash flow is not just about tracking bills. It's also about making sure you have enough liquidity for day-to-day needs without overburdening yourself with debt. Example. Let's consider a family with 2 working parents earning a combined $6,000 per month. They spend $2,000 on rent, $600 on groceries, $200 on utilities, and the rest goes to savings, debt repayment, and discretionary spending. By following a clear budget, they can prioritize their expenses and ensure they are saving adequately for both short and long-term goals. The growing cost of education. Education is one of the most significant expenses a family faces. The average cost of tuition in the U.S. can be astronomical. According to recent data, the cost of attending a public 4-year college is around $10,000 per year in state, and private colleges can cost upwards of $40,000 per year. The earlier you begin saving for college, the less of a financial burden it will create in the future. 529 College Savings Plans, a great tool for families. The 529 plan is one of the best tools for saving for college. It's a tax-advantaged account where you can save and grow money without paying taxes on the growth, as long as the money is used for qualified educational expenses. State tax benefits. Some states offer tax deductions for contributions to 529 plans, which can give you an additional advantage when saving for college. Flexibility. Even though 529 plans are designed for education, if your child doesn't need the funds for school, you can transfer the funds to another family member or pay a penalty in taxes. Real-life example. Sarah and Mike have a 5-year-old daughter, and they start contributing $150 a month to a 529 plan. By the time their daughter is 18, they could have close to $40,000 saved for her college education, depending on the growth of the investments in the plan. Other college savings options. Coverdell Education Savings Account, ESA, allows up to $2,000 per year in tax-free contributions for educational purposes, but it has income restrictions and lower contribution limits. Custodial accounts. If you want to give your child control of the funds at a later age, consider UTMA/UGMA accounts. These accounts offer more flexibility, but They are not tax-advantaged like 529 plans. Engagement opportunity. For those of you with kids, have you started saving for their college education? What strategies or accounts have you considered? Scholarships and financial aid. While saving for college is important, don't forget to research scholarships, grants, and federal aid programs like FAFSA. A lot of families miss out on financial aid simply because they don't apply. If you can combine your savings with financial aid, you'll significantly reduce the burden on your family. Insurance planning. Protecting your family's financial future. Insurance is an often overlooked but crucial component of family financial planning. It ensures that your family is financially protected in case of unexpected events like illness, accidents, or death. Life insurance. Term life insurance. A cost-effective option that covers you for a specific term, usually 20 or 30 years. This type of insurance is often the best choice for young families because it's affordable and provides a large death benefit. Whole life insurance. More expensive, but provides lifetime coverage and has a cash value component that grows over time. How much life insurance do you need? A good rule of thumb is to have life insurance coverage that is 10 to 15 times your annual income. For example, if you earn $60,000 per year, your coverage should be between $600,000 to $900,000. Real-life example. Tom and Lisa have 2 young children and a mortgage. They purchase a 20-year term life insurance policy for $500,000. This ensures that if something happens to Tom, Lisa will have enough money to pay off the mortgage, cover living expenses, and secure their kids' futures. Health insurance, employer-sponsored plans. If you work for a company that offers health insurance, it's essential to understand the benefits and choose a plan that meets your family's needs. Marketplace plans. If you don't have employer-sponsored insurance, the ACA Marketplace offers subsidized plans that can make insurance more affordable. Disability insurance. Disability insurance is often overlooked, but it's just as important as life insurance. It replaces a portion of your income if you become unable to work due to an illness or injury. Engagement opportunity. How many of you have considered life insurance for your family? What type of coverage do you have, and why did you choose it? Debt management. Tackling debt as a family. Debt is one of the biggest obstacles to financial freedom for many families. Whether it's credit card debt, student loans, or a mortgage, managing debt effectively is crucial. Debt snowball versus debt avalanche. Debt snowball. Pay off your smallest debt first, then move on to the next smallest, and so on. This method creates momentum as you eliminate debts one by one. Debt avalanche. Pay off your highest interest debt first. This method saves you more money on interest in the long run. Example. Let's say you have 3 debts. $500 in credit card debt at 18% interest, $5,000 in student loans at 6% interest, and a $10,000 car loan at 4% interest. The debt avalanche method would have you pay off the credit card debt first, then tackle the student loan, and lastly the car loan. Refinancing. Consider refinancing high-interest loans, like credit cards or student loans, to reduce your interest rates and monthly payments. Refinancing your mortgage can also help you lower your monthly payments, potentially freeing up cash for other goals. Building an emergency fund. Before aggressively paying down debt, make sure you have an emergency fund with 3 to 6 months worth of living expenses. This will provide a safety net if you face an unexpected job loss or medical emergency. Engagement opportunity. Who here is currently working on paying off debt? What strategies have worked best for you? Saving for retirement. Retirement planning for families. Many families put retirement savings on the back burner because of immediate financial needs, but failing to plan for retirement can result in financial insecurity later in life. The earlier you start saving, the better. 401k and IRA contributions. 401k. Contribute enough to your 401k to take full advantage of your employer's match. This is essentially free money and a great way to boost your retirement savings. IRA options. A traditional IRA allows for tax-deferred growth, while a Roth IRA provides tax-free growth. The choice between them depends on your current tax situation and future expectations. Catch-up contributions. If you're over 50, you can make catch-up contributions to your 401k or IRA. This allows you to contribute more than the standard limit to make up for lost time. Example, suppose you're 40 years old and start contributing $500 a month to a Roth IRA. By age 65, assuming an average return of 7% per year, you could have over $600,000 saved for retirement. Engagement opportunity. Have you started planning for retirement yet? What accounts are you using to save, and how much are you able to contribute each month? In conclusion, financial planning is a continuous journey. It requires discipline, regular review, and flexibility to adjust as life changes. Whether it's budgeting, saving for college, protecting your family with insurance, managing debt, or preparing for retirement, each step you take today brings you closer to a financially secure future for your family. Remember, it's never too late to start, but the earlier you begin, the better prepared you'll be. Stay focused on your goals, keep educating yourself, and take proactive steps toward securing a brighter future. Thank you for your time and attention today. Don't forget to subscribe and share this information with others who might benefit. Let's build a community of financially empowered families together. Thank you, and take care.